Good afternoon, everyone. This is Mark Robertson with the 506 Investor Group. Today we have another in our series of sponsor webinars. As usual, we'll have the first 30 minutes will be a presentation by the sponsor, and the last 30 minutes we'll do a Q&A section. So I am proud to introduce Christopher Zook, who's the Chairman and Chief Investment Officer of CAZ Investments, and he's going to discuss the Private Equity Ownership Fund 2. Welcome, Christopher.
Thank you very much, Mark. We appreciate you setting this up and happy to be here. I know we have some folks on the call that know us fairly well at this point, and we have folks that don't know us at all. So I'm going to go through the presentation really fast so that way those who have seen it before don't get too much duplication, and then obviously we'll address anything that we blew by too quickly in the Q&A. So we'll start off with the disclaimer, of course, is always the most important thing to show. Past performance no guarantee future results, and only available via the private placement memorandum and limited partnership agreement. So we're going to talk about why we're making the investment, challenges facing investors, which we're going to speed through, why private equity is growing, which is the theme that we're involved with here, and our approach and specifically the fund. So the net result of why we're making the investment is it truly is one of the very best predictable cash flow streams that we've been able to locate for me in my 30 years plus of investing. But we're able to do that with very proven and established businesses. We don't have to wait for people to figure out how to be successful. We're already investing in companies that are wildly successful at the time that we invest, which gives us a lot of upside optionality, but it gives us this really unique structure of downside protection that is only available basically in this asset class. We get to own some of the very best companies in the world, not to mention the best private equity firms in the world, and we're co-investing with some of the smartest and largest investors on the planet. So the challenges facing investors, I'll go through this very quickly. It's pretty self-explanatory. Stocks are expensive. Doesn't mean they can't keep going up, but they're certainly expensive. Interest rates are very low. Obviously, it's really hard to make a case that interest rates are going to go up a lot from here anytime real soon. And so we think investors should be asking themselves questions such as, how much risk do they really have in the portfolio to a market pullback? You know, think about 2008. Think about how you felt in September, October, or early 2009. And that is something that you don't want to feel again. Make sure you have an exposure in the portfolio that you can tolerate. And then how much yield can you get without taking too much interest rate risk or default risk or credit risk? So is there a place to invest in this day and age? And the answer is it's hard. It's really hard to find things that are non-correlated, that are going to have predictable cash flow streams and upside to give investors the opportunity to earn the target returns that they would like to earn. So the theme is why private equity is growing. And we believe that private equity is going to continue to grow as an asset class. There are now a significantly larger number of companies, private versus public, compared to what we've seen at times in the past in the United States. We think this is going to continue. And part of the reason why investors continue to invest in private equity as an asset class is strictly performance. It's been the best performing asset class of all time. Whether you look at 15 years, 25 years, you have massive outperformance on a net basis for something as simple as the Cambridge Index compared to the S&P and certainly the bond market. And it should give us a higher rate of return because we're giving up something. We're giving up liquidity. And if we're going to give up liquidity, we should be paid better. But when you look at the power of compounding and you look at what investors, particularly institutional investors, need right now, which is a 7, 8, 9, 10% rate of return, it's just virtually impossible for them to mathematically see how they're going to do that with a traditional 60-40 mix of stocks and bonds. So they're looking at charts like this and realizing that they need to increase their private exposure, and that is causing the asset class to grow assets under management at a very consistent and very strong clip. 10% top line growth in assets under management, for the last decade plus, and we don't see that, slowing down anytime soon. So how can you benefit from the trend? And I think that most people will agree that, this trend will continue, and anyone who's been involved in any kind of pension, analysis and looking at actuarial assumptions of 6, 7, 8, 9%, it's just virtually impossible to see how they don't increase their private exposure in order to try to get the returns that they need. So try to find a way to own the firms themselves that are going to benefit from that growth. Obviously, this is something that we do. We talk about a lot. Is very, very few investors focus on who's aligned with them and where the alignments are when the alignments are not. It's very important that you invest with a firm in whatever you do that is co-investing alongside of you, to where they are truly committed with their own capital to what they're doing. And if you can, find somebody that's going to get paid primarily based on your success, not just their marketing success. Don't just invest with somebody who's really, really good at sales to where they're getting people to invest in their fund. Invest with somebody who's getting paid because they actually deliver performance and they deliver on the commitments that they make to people. And then if you can, try to find preferred economics. In most of the cases in the private equity world, that comes in the form of co-investment rights or co-investment opportunities where there's significantly improved fee structures. And then, the J-curve is a reality of private equity. But there are some investments, and we think right now in the cycle is really, really important to try to minimize that J-curve the best you can. So we're doing a lot of investments. We've been making investments that really focus on small J-curves, very shallow J-curves. So our approach, for those that don't know us already, usually we're able to provide access to things that people can't get to on their own. Sometimes it's because the minimums are too high. Sometimes it's because you have to have been in the previous fund to get into this fund. Sometimes you just have to be able to get the phone call to get that co-investment opportunity. And sometimes we can get preferred economics or preferred co-investment rights simply because of the size that we bring to bear. And we're backed by some of the most prestigious and well-known families in Texas. They're shareholders. And we've committed over $275 million of our own money directly alongside our partners in the vehicles that we have invested. We are the largest investor in virtually everything we do, and every dollar that goes, every time we make an investment, the very first dollar that goes in is mine. Individually, we're small, and collectively, we're very large. I mean, this is a good example. On this call right now, I don't know how many people there are, and all of us have nice net worths, but compared to a multi-billion-dollar, pension plan, we are not as large as they are. But when you collectively add up everybody who's on this call, it's a very large buying group. And if you take our entire ecosystem, which is hundreds of families, investment advisors, institutions, etc., we are an extraordinarily large buying group, which allows us to aggregate. There was an article that came out in The Economist not too long ago that talks about how there's just over 360 investors in the world that have committed $1 billion to private equity. We are in that camp. We have well over $1 billion of private equity exposure, and we are collectively a very large institutional investor, which gives us access, buying power, negotiating power, etc. I already said we're the largest investor in our vehicles. And what does make us the most unique, and I'll preface this by saying in not every single case, but in virtually every case, we don't charge management fees. We are purely compensated based on performance, to where if we don't make money for people, we don't get paid. And we do that in a unique fashion because of our kind of multifamily office structure that allows us to be 100% aligned, the very best that we can with our partner. We're the biggest investor. We don't get paid unless it's profitable. There's only one reason why we're making this investment, because we believe it's going to work. And we're willing to put all of our economics on the success of the vehicle. So we are very thematic. People ask a lot of times, how do we possibly screen through the 1,500 investments we'll look at this year? And the answer is, most of the time, if it doesn't fit a theme, it doesn't get a second look. We try to find a theme, find the wind at our back if we can, then figure out the best risk-reward way to take advantage of it, and then from there, find the best partner. We're very, very, very certain of what we don't know and very comfortable with what we do know. And ultimately, we are very good at finding who usually is the best in a particular space. And because of our buying power, we can partner with them and get access to them. This blue line is the S&P 500. the purpose of this chart is to just show you how, as the markets change, we change also, and we are very thematic. So shorting subprime with John Paulson in 2007, picking up all the pieces of the financial crisis in 2008 to 2012. Then as the market got more expensive and assets in general got more expensive, we've become less and less correlated to the overall market. And we're focused on not being reliant on just an S&P going up in order to make good money. We are very, we cover a pretty broad base of investments on the liquid side. We do have 2 vehicles on the liquid side. Currently in our thematic investments, on the thematic private equity investments, as you can see, it's typically, one theme, multiple funds in that particular theme, or one fund for the whole theme, etc. Equity investments we do in a very non-traditional way, even though they are more traditional investments. And then our fund of themes provide people with one investment to be able to get access to everything we do in a particular space. Liquid income is our cash alternative. It's a place where I park all of our personal cash, our firm's capital. Our partners use it for capital calls and distribution, management, working capital management, if you will. The Barbell Fund does everything thematic in the liquid world, and then our private equity access funds provide access to everything we're doing in the private markets. So let's talk about PEO2. So PEO2 is our partner is Dial. Some people are familiar with Dial. They've been in the press a lot over the last year and a half. It's not hard to figure out who they are. But some of the things you might not be aware of is they are a subsidiary of Neuberger Berman, the $300 billion plus firm. They have 4 funds, and I want to be really clear about how I use the naming functions here. So Dial Fund 1 and Fund 2 were focused on hedge fund equity stakes. We did not participate at the time those funds were raised in either one of those funds. We love the team, we love the approach, we loved being on the GP side of the table, but we did not feel really comfortable with the hedge fund business model, where if you have 2 years of bad performance, you can literally be out of business. And so we waited until 2016 when we participated with Dial in their Fund 3. We were about 3% of their $5.3 billion fund, and we obviously are participating in Dial Capital 4. So to be very clear, because we're going to talk about both PEO1 and PEO2 today, Private Equity Ownership Fund 1 invested with Dial Fund 3, and PEO2 is investing in Dial Capital Partners 4 and the co-investments alongside of that. Okay, so as you can see here, we own stakes in some of the very best private equity firms literally on the planet. Some of the most well-known, some of the most successful. Very pleased with our participation there. It's really critical in order to evaluate this investment. You have to understand this slide. And I will tell you, even some of the most sophisticated investors that we know miss pieces of this puzzle. Here's what you need to understand. When you are the general partner of a private equity firm, you get paid 3 ways. Everybody knows what the management fee is, and everybody knows what the carried interest is. And yes, those are critically important. But don't forget number 2. When you're investing as the general partner in your own fund, you obviously don't pay management fees and you don't pay carry to yourself. So if you're investing as a limited partner in a fund that is generating a 20% net return to its investors, if you back out all the management fees and carried interest, that's the gross return that actually the general partner is getting on their own money in their own fund. When we buy a stake in a Silver Lake or a Cerberus or a Platinum, etc., our investment into those funds as the general partner grow without having any management fee or carry burden placed on them. And that is a huge portion of the profitability of these companies. So when we own a 20% stake of that company, we get 20% of all the benefits of that balance sheet growth. We get 20% of all the benefits of the management fees, etc. Really critical to understand that, because it's a big piece of the puzzle that creates less risk in the overall investment.
Can I ask you a quick question on that 20% part?
Sure.
The 20%, if we bought 20% of a firm, so we're entitled to say they had a 2% asset under management fee, how much of that 2% flows to us? How much overhead, et cetera, does the firm take? So what's our probably net percentage of that 2%? or is it actually 2%?
Usually the way it works and the way it's set up is it is a profits interest. So we own 20% of the profits of the business from wherever it comes. So to answer the question maybe a little more completely, the typical firm that we own runs about a 60 to 70% net profit margin just from management fees alone. So if you extrapolate that, you'd say roughly 1.2 to 1.3% of that 2% is actually going to come to the owners of the business. Obviously, us as the shareholders of the business, obviously our 20% would be of that net number on the management fees. Then, of course, we would get our benefit from the balance sheet. Then also we would get the benefit from the carried interest as well.
And the other revenue streams are similar, 60, 70% profit margin?
Yes. No, see, that's the beauty of it. Is these firms, they generate 60 to 70% profit margins just from the management fees, which means that all that balance sheet profit and carried interest is icing on the cake. Now, to be clear, the carried interest, a big chunk of that's going to go to the team. Obviously, that's who needs to be incentivized. The typical range is about 40% of the profits, or the carried interest is going to go to the management team of that particular fund. And then the management company is going to keep about 60%. So that's why actually in a slide you'll see here in a couple of seconds, if we bought 20% of a firm, typically we're going to get 20% of all the management fee profits, 20% of all the balance sheet profits, and then we're going to get usually about 12% of the carried interest profits because of the fact that, of the carried interest itself, because 40% goes to the team, that leaves 60%, we own 20% of the 60, that gets us to our 12.
All right.
Okay.
Sorry about that. Thank you.
No, that's perfect. So the first question that most people ask, which is the very first question that I asked of the Dial team, is these private equity firms are run by some of the smartest investors on the planet. If they're a seller, why in the world would I want to be a buyer? And so what this graphic will show you is it's actually for reasons that most people would never think about. And to be very clear, this is not, beach money. This is not, hanging up the cleats and I'm going to the mountains, so to speak. There are no transactions that are being done to just provide, the really key people with just some real nice exit dollars. That's not the purpose of these transactions. If you want to grow a business, you have the majority of the transactions are done for growth purposes, and I'll talk about those in a second, through what's called a primary capital investment, which is on the left side, and I'll leave it up here so everybody can see it. The secondary sale transactions, there are some, and that's where we're actually buying our stake from someone. Somebody's a seller, we're a buyer. Okay, that's what a secondary sale is. It's not going to be just, the founder of the company is deciding he wants to take some chips off the table. If there are occasional times where the founder will be able to do some estate planning or do some gifting planning, those kinds of things, but the vast majority of the secondary sales that occur are where you have, let's say, a company's 30 years old and it was founded by somebody when they were 60 and now they're 90. They haven't been involved in the business for 10 years, but it's $500 million to buy them out. Well, the company may not have that much cash of its own, or the founder, the next second generation doesn't necessarily have that. So there is some of that. There has to be some really good strategic reasons for that. A very common one is that there was a backer, a non-affiliated backer, who was put up capital originally to start the company and got a stake in the business, and now they're either past their ability to help the business any longer, or it's an institution who's looking to sell their stake after owning it for 20 years. Those kinds of things do happen. But the vast majority of the transactions are primary capital, where the money goes onto the balance sheet, and it is there to grow. It is to grow either the fund sizes or to potentially diversify into a different product line or a different geographic line to where they have the ability to invest. And keep in mind, these are not capital-intensive businesses in the classic sense, where you got to go build a factory and equipment and all that kind of good stuff. What this is that if you're going to put 4% of your general partners, of your fund size in as the general partner, if you raise $1 billion, that's $40 million. You go out and raise $10 billion, it's $400 million. So it's really important for people to have the balance sheet to be able to grow and also to be able to attract and retain the talent that they need in order to do that. So Dyal's really, really good at making sure that there's always a very good strategic reason for the transaction. Otherwise, they're just going to pass. So let's talk about the downside. I didn't say this earlier, and it's really important. And don't worry, you'll be able to see more details on this when you get the presentation off of our website. But the philosophy we have as a firm is we always ask ourselves, what's the worst case scenario? How do we get hurt? How does this not work out as planned? And if we can live with that, then the upside will take care of itself. So just the same with you, and I'll blow this up so you can see it a little bit, we're going to look at the downside scenario first. So we go through a pretty draconian scenario here. We assume that this firm that we invested in, they raised their 2019 fund and they never raise additional capital ever again for the next 12 years. So they've done great for the last 20, but all of a sudden they no longer could raise money for the next 12 years. Is that likely? No. Is it possible? Of course it is. And so we want to look at that scenario. We also assume that they never make another dollar of profits ever for investors again. The existing funds never get marked up, never have any realizations above where they are today, and every new dollar that comes in literally just exits at cost. And so the business just scales down and runs off basically as the management fees decline. It's a draconian scenario. And keep in mind, this is one specific investment that we would be looking at. In a portfolio of 10 to 12 companies, is it possible that all 10 to 12 could have that happen? Certainly, it's theoretically possible, but it's really, I don't even say it's a realistic assumption to say all 10 or 12 that have been around for 20 years, all of a sudden all go out of business. You just don't see that as being realistic. But let's look and see how it is on a single name situation. So we got 20% of the management fees. Just from the management fees of the existing funds, we would get back half our money. Just from the return at cost, current value of our balance sheet investments in our own funds, we would get back the other half roughly of our money. And there'd be a little bit of carried interest because of the fact that the existing funds have some markups in this illustration, would give us another 2.2, I should say. It gives you a 1.21. And, to be clear, nobody would be excited about that. Nobody would like an investment for 12 years that gave you a 1.2. That would be really, really not an attractive result. But if that's the worst case scenario, that's not that bad, and the upside certainly will take care of itself. But you also don't have to wait 12 years to get back your $1.21. In this particular situation, like all of these investments, it's a cash flow vehicle because they're profitable today, throwing off cash flow right now. And as you can see on the chart, for this hypothetical situation, you'd have back basically almost all of your money within the first 6 years, which means then you could put it to work in something else that hopefully is doing better. So that's kind of a draconian situation, which is definitely something that we could live with. So we look at the base case scenario. Again, you can study all the details later, but we assume, going back to what I said just a minute ago, 20% of the management fees, 20% of the balance sheet, 12% of the carry. We pay 6 times, and we pay it in over a 3-year period of time. 105 just for management fees, another 1x from the balance sheet, again, very significant portion of the return, and then carried interest of the 118. So just from cash flow of 323. Now, it's only logical to apply some terminal value or certain enterprise value to this very profitable business. So if you assume that we sold it the same 6 times that we bought it, we'd be at a 426. And if you saw an increase in valuation, which we think is very possible for reasons that we can talk about in a minute, but we think 9x would give you a 498 on the investment. And again, cashless. Really important that I stress on this just for a second. I'm trying to go fast to stay within the time constraints here, but it is lumpy. It is lumpy for these investments because private equity firms go through things just like farmers. They plant the field, they cultivate the field, they harvest the field. They don't happen at one time. So as you can see, there are periods of time where the distributions are very low because of the fact it's just planting the field, and so you're just getting management fee income. And then all of a sudden, you got a lot of harvest going on, and the numbers get much bigger. and then you're planting and cultivating, and then you're harvesting and planting and cultivating and harvesting. Again, when you have 10 to 12 different positions, they're not all going to be planting and cultivating at the exact same time. What I can tell you is it will be lumpy because of just the business cycle. Because naturally, if the markets are lousy and we're in the middle of a recession, you're not going to have a tremendous amount of harvest. You're still going to get your management fee income. But all that harvest is when your balance sheet profits and your carried interest is going to kick in. And so what will happen, and we're managing people's expectations, is in just planting and cultivating years, it's an 8 to 11% type, 8 to 12% type yield. And then all of a sudden, when harvest happens, it's going to come in buckets. And it'll be 18, 20, 25, 30% of distributions to us. And then it will go back, and it will be 8, 10, 12. And it will be lumpy. Be mindful of that as you make the investment. So when you look at the fund itself, $7 billion fund is going to end up being close to $8 billion. Very little called initially for reasons that are based on the tranche transactions and the way they go about utilizing a subscription line. But they've committed 58% of the $7 billion that's shown on this chart, with the managers that we own stakes in these firms that you see here below. In the appendix, you'll be able to look at more detail on these particular investors, but suffice it to say, these are some of the 800-pound gorillas in the world. HIG, $32 billion, HPS, over $50 billion, Solid Capital, $30 billion, Bridgepoint, one of the largest in London, one of the most well-known European firms. American Security's been around for 40 years. Clearlake, based on the West Coast, one of the fastest growing firms in the country. And it is a very diversified portfolio across geography, across styles, sector, etc. This chart, I'll go back to it, just helps understand the safety and the protections that we get. So what this shows is the existing investments we have, not including the other 5 or 6 investments that will be made in this fund. Just the existing investors' investments. They have 119 different vehicles with over $12 billion of contractual management fee revenue that they do not ever have to raise another dollar to earn $12 billion. And obviously we will get our share of that, which gives us tremendous protection on the downside. This is our Fund 1, so Dow Capital 3, PEO 1, just gives you an idea of what your expectations would be, because we expect them to be pretty similar. About half of the earnings distributions have come from balance sheet and carry, and about half from management fees. So about half of this we would expect to be ordinary income, and about half of it we would expect to be long-term capital gains. Certainly may not all be long-term capital gains over here, but that is a good rough numbers of 50-50 mix. And as you can see, every one of these firms are doing well, and obviously that's PEO 1. What is very important that you understand when you make this investment is you have to size it correctly. Because of the fact that it's a cash flow vehicle, you're going to be getting money in your left pocket at the same time you're meeting calls out of your right pocket. So this is what the actual results have been in our Fund 1. 60% called, 23% distributed. It is not exactly every quarter, but we've gotten 10 distributions in 10 quarters. And 38% of what we put out of our right pocket, we've already gotten back in to our left pocket. Running at a 132 already in less than 2 years, and a net IRR of 17.6. And that is, that's just, we're just now getting out of, if you will, the beginning phases of the J curve and the full deployment of the capital. So what we did differently with Fund 2, and I want to make sure everybody understands this. Fund 1, we just invested in their fund, Dow's fund, and then we had co-investments as standalone vehicles outside. What we did in our Fund 2, in order, for a lot of different reasons, but to make sure it was fair for everybody and to bring down the operating costs for the average investor, we decided to go with a mix. So it's a $350 million fund. Roughly $175 million is going to go into Dow's Fund 4. That's at a 2 and 20 with an 8% pref. Very standard, classic private equity structure. But the co-investments that we make alongside this are no management fee, no carry. So when we mix it 50-50, which is what we have visibility to and what we expect to occur, it gives us a blended fee of a 1 in 10, all in. So the Dial fee is a 1 in 10 with an 8% pref. Much, much lower, something that would be virtually impossible for anyone else to replicate. We are getting those co-investments because of the size of our investment. Again, we're $175 million out of their $7+ billion fund. So key points as I wrap up to get to Q&A here is, great businesses that we get to own stakes in, very predictable cash flows, lots of opportunity for growth, great optionality, great downside protection. There virtually is no J curve because we start getting investments back immediately. Actually, the first distribution that you will share in was a 20% cash on cash distribution for just literally the first 12 months of the fund's life. So that you'll get literally right after you make the investment. So we've already had two co-investments, HIG and Golub. We expect at least one and possibly two before year end. We are 15% called on the fund right now. The key for you as you size properly is you realistically, mathematically, it's hard to make a case that you're going to write a check for more than 70% of your commitments, and also probably not less than about 50%. PDL1 is probably going to end up being about 50%. But for budgeting purposes, we would tell people, if you really want to write a check for $1 million, commit $1.5 million to our vehicle. The reason why is if it turns out to be 80%, okay, you're going to write a check for 1.2. If it turns out to be 50%, you're at 750. But if it's in that 60 to 70% range, you're actually going to get to deploy about $1 million of your capital that way. We expect the fund to be fully committed, but called gradually. So most of these transactions are tranched over 3 to 4 years. And so that's why they make the commitment. They buy the stake in the business. They get the full economic benefit of the ownership of that stake, but we don't actually have to write a check for that 4 to 5 year period of time or 3 to 4 year period of time for those tranche payments. So minimum commitment, $500,000. Qualified money is accepted. So you can invest through your IRA, through your foundation, your charitable trust, whatever, or obviously through your taxable entity. It says subscriptions monthly from QPs. The reality is that we're, at about, call it 330 of our 350 million. So there's not a lot of capacity left. We will make sure there's capacity available for 506 group members, but there's not, not a long way here, folks. This is November 1 is ideal, and then December 1 is probably the outside date in order to be able to get in the investment. The carried interest, we just, no management fee. I skipped that. No management fee of any kind. We do not earn any fees except for a percentage of the profits. Normally, it'd be 20% of the $500,000 investment. For 506 group members, we agreed to reduce it to 10%. Investment period 5 years, obviously not liquid, but the K1 does come very late. So if you're thinking about investing through your family partnership like I do, just know your K1 is going to come late, and it's going to come very late. If that's a problem for you, then talk to us. We'll come up with what the best solution is for you. Attorneys are Jackson Walker, and our auditors, Deloitte & Touche. Partners admin handles all the admin. So summaries already kind of hit these points. I mean, this is a compelling risk reward for our personal capital. We've got collectively as our shareholder base, probably end up between $90 and $100 million across all of our affiliated entities in this investment. And, we obviously are putting our money where our mouth is where it comes to our investment in the fund, and then also the fact that we don't get paid unless people make a profit. So I think that gets us to a great point for Q&A.
Very good. Thank you so much. That was very informative. I guess I had a couple of questions about concentration risk. One would be the co-investments, in the end of the day, what percentage of the fund will be in, what's the highest concentration in any one thing? I guess HIG, there's a sidecar. So how much is that sidecar investment? And then how much of the fund, what percentage of the fund is in that? So the total, what is their total percentage in HIG or any other fund, any other firm?
Sure. It's an excellent exercise in math that I'll walk you through. So let's assume that they put 10% of their fund in a particular investment, they being Dow. Yep. So Dow puts 10% of their fund into that investment and then does a co-investment, and that ends up being an extra 10% of our vehicle. So you could theoretically have 20% in one specific name. The reality is probably less than that. They're going to end up with 10 to 12 different positions. They're going to end up with, as a result, typically around 7 to 8. If we end up with, 10% of ours, if you assumed 5 co-investments of 10% each, 50% of the fund, 5 co-investments, 10% each, then you would end up with about 17 to 18%, maybe 19, maybe 20 in any one specific investment. But what we do expect is we expect more than 5. So probably not 7 and probably not 4. So 5 to 6 is the visibility we have, which would mean that we will look at basically 5 to 6 positions that will end up at about 15 to 19, maybe 20%. And then obviously the other positions would end up being 5 to 10% weight of the overall fund.
And what is the co-investment number that we put into HIG and the other one, which I can't remember?
So HIG and Golub, we did $30 million in HIG. We did $40 million in Golub. So we've got $70 million of the 150 currently deployed, which gets us to, in the case of a Golub as an example, it was about a 9% weight in their fund. So it's, that's 4.5 plus obviously roughly, back of the envelope here, roughly 24%. So it gets us to, of our 50, so that gets us to a blended is about 18, 19% in Golub, and then HIG would be about 15, 16, if I did my math on the back of my envelope correctly.
All right. And then I guess the other question is the diversification versus strategies. How many different is there any requirement within Dial or with you guys if you'll only have a certain amount of concentration in one PE style? So if one style goes out of favor and it goes to the heck in the handbasket and some funds have to dissolve, what is our exposure to any one strategy?
That's correct. Very, very much so. They do limit that. They do not really want to have more than 2 investments in the fund that are highly correlated or that have a lot of similarities. So in the case of credit, as an example, we have Golub, we have HPS. They're both credit managers, but they're in very different spaces within credit. But that's, the big exposure, from the standpoint of they're pretty much at their max exposure. I'm not going to say they won't do any more in credit, but it would be less likely that they would do another credit investment. You look at they typically don't do venture just because it's so hard to underwrite. It's very little predictability there. But when you look at, as an example, energy, if they have an energy investment in this fund, it'd be unlikely that they would have certainly more than 2 and probably just 1 if they had a commodity-based, strategy in there. So they definitely range it through, like in HIG as an example, they're more of a mid-cap, small-cap type player, middle market. And then you have something like American Securities, it's a little bit more large cap. You have HGGC, which tends to be a little bit more growthy as opposed to, to a buyout type. And so they are diversifying across strategy and also geography significantly, particularly when you look at the Bridgepoint as an example. And I would expect at least 1 other European transaction based on what they told me, and possibly 2 other European transactions, which will continue to diversify the portfolio.
And I think I heard there's 3 other that they're in talks with. Do you know what strategies those are?
I do. One, got to be careful to make sure it's not too identifiable, but one is in a very large infrastructure player that they have under exclusivity, and then another one that is in the energy space. That's why I referenced that. And then there's another investment that they have. It's not under exclusivity, but they're very, very close with the team there, and that is more of a European kind of middle market organization.
And is there any research done on the age of some of the underlying funds and when some may be going full cycle and when those economic events will happen? So.
Yeah, no, I mean, when they do a phenomenal job. That's one of the things that impressed me the most about the Dial team is they do such a great job of building everything from the bottom up as though they were going to literally own those portfolio companies, because technically we do. So they go through and look and underwrite every single position and every single fund and every single sponsor that they're evaluating and then they evaluate literally all the, stress case scenario, best case scenario, base case scenario, worst case scenario. of exactly what that would mean for that particular manager, how that would all flow through to the bottom line, all the way through the income statement. One of the things they also do a great job of, which kind of refers to something you asked earlier, is they do a great job of protecting us. We're obviously minority investors in these firms. We own 20% typically. So it's very important that we protect ourselves as minority investors. And Dial has done this for 25 years in their predecessor business as well as Dial. And so they know really, really well how to avoid, the founder deciding they're going to buy a Picasso with our money or buy a G6 with our money. They're not going to do that. If they want to, spend money beyond the budgeted amount that's determined at the time of the investment, it comes out of their share. It doesn't come out of ours, as an example. And that's one of the ways that they go about protecting us. And in the underwriting process, that's just a good example of how they go about building it all the way through the income statement.
All right, and then back to the concentration. If there's 30 in HIG and 40 in the other one, that's 70, and then assume another 10 million if it was 10%. So that's 90 million. So we're really about 36% in two funds. Is that accurate math?
Out of the 350, yes, that would be reasonable to extrapolate.
So the fund is 250 or 350? I'm sorry.
350.
350. Okay, I thought I had 250.
Yeah.
All right.
Yep.
And I'm assuming that we can see samples, redacted statements, and quarterly reports from this fund and previous funds.
Happy to do that. We do a very good job. We have 48, 49 funds, and so our administrator is very good about providing us with timely statements the best we can. Obviously, it's private equity. But 45 days after the end of every quarter, you get a statement. It's based on the most recent valuation we have from every underlying manager. And then obviously you get your year-end statement as well. We also send out what we call our gospel statement, which is in May after all the audits have been completed. Then we send out an updated statement that has all 12/31 values. So everybody knows exactly where they stand on 12/31. And then obviously the K1s come when the K1s come.
All right, and there's a question on how much of the balance sheet we actually get. So for every dollar we invest into a company, what percentage is actually a balance sheet investment? So they put the value of a firm,
basically
10%, 20%.
Yeah, it's 20% of the balance sheet is what we get. Now, how much that balance sheet is as a percentage of the overall enterprise value is very significantly different from firm to firm. But one of the things I didn't say earlier, and I should have said, is, we are 100% shoulder to shoulder with the founders and the people running the business. So they are not able to distribute any capital to themselves other than their salary, et cetera, unless they also make a distribution to us. So that is true on the balance sheet as well. If they have money in the balance sheet, that money is being deployed across the various vehicles and what they're doing. Obviously, we're coming right alongside them, and we're truly shoulder to shoulder with those founders.
So I'm assuming Dial has set parameters that they can't change their corporate structure and overhead and fee us to death.
Correct. Absolutely. They have a great. That's one of the reasons we chose Dial, and we know pretty much everybody in the space. But Dial has done a tremendous job of the protections for us as the minority investors against the what if and potential bad things that could happen if people if people change and control changes, etc. So we have change of control provisions. We have votes on all that kind of good stuff. We have piggyback rights when they go public, etc.
So just an example, do you have a ballpark number? If we invested $10 million, you bought an entire PE firm for $10 million, the enterprise value, what's a ballpark of what their balance sheet invested is? Could it be $1 million or?
I mean, that's a reasonable number to use. It literally is very different. As an example, Platinum's balance sheet, I don't want to say anything that's not public, but Platinum's balance sheet, they don't typically just invest in their funds. They do everything deal by deal. So they typically will take anywhere between 10 and 50% of all of the transactions they do. So their balance sheet is huge. Same with a Golub compared to others who are just more of the traditional 2%, 4% of their fund. They're going to have a smaller balance sheet. But, for some of these names, the balance sheet might be 50% of the enterprise value, depending on how they're structured.
All right. And then the PPM allows you to obtain leverage. Can you explain the intent and plan and when and how you've used it in the past?
We absolutely positively, this is not a levered fund. The only time that leverage is used is just literally facilitating capital calls and distributions. We do our capital calls once a month. We do our distributions once a month. We do that so that people that are in 10 of our vehicles don't get a capital call notice every 3 days. They can plan and budget accordingly. Well, obviously, the calls and the distributions don't necessarily match up with that, so we will utilize the line of credit to facilitate those calls. It is never used to enhance returns or designed to, juice up, the performance of the IRR or anything of that nature. It's strictly to facilitate timing.
All right, and then there's a question about the sidecar deals with the 0-0 from Dial. The writer says they didn't see it in the PPM. Is it actually in the PPM, or it's just
it's not going to be in the PPM? It's not going to be part of the PPM. I mean, our investments with Dial, they do all their co-invested 0 and 0. They've done that for not just us, but for everybody that participates. There's typically a half a dozen to a dozen institutional investors that participate, all typically very large partners of Dials. And so as a result, that's their policy is 0 and 0, because we're helping them facilitate a transaction that's too big for their fund. Their fund's $7 billion. Going back to your point on diversification, they're not going to put $2 billion into one specific transaction. That would be too large for their fund. So if they're going to put $700 million in the fund, and it's $1 billion transaction, $300 million needs to be raised in the co-invest in order to facilitate, that deal getting done. And so because we're obviously coming alongside and helping them with that, the benefit to us is the 0 and 0.
And then I guess another question about the skin in the game that CAZ will actually have at the end of the day. I think it's my understanding that the late investors like ourselves coming in will be actually replacing your capital. So what ultimate number do you expect?
No, actually, I'll clarify that. That's not the case. So our family's investments are not changing. No one is displacing us. We have our fund of private equity that I referred to earlier called Private Equity Access. That vehicle is, we're taking some of the capacity away from that future vehicle that has not even been started yet, and we're going to allocate that for folks like you that are coming in later, because otherwise we would have been filled and not able to take any new investments. So our personal capital, nothing changes. This is just stuff that was capacity that was earmarked for our next private equity access vehicle. That is going to be released in order to facilitate your membership to be able to participate.
I mean, if you had more demand, not just from us, but from whoever, could you not just add to your investment with Dial, since they're still open until, I think, the end of this month?
It's yes, we can, and we actually could do that. What we want to be careful with is the 50-50 mix. So we have good conversations and visibility with them to the other, line of sight, if you will, on the other 80 million plus 80 million, $105 million that we want to get to 175 million of co-invest. So if we just all of a sudden up the size of the fund in general, we just would not be able to say with a straight face that it's going to be a 50-50 mix. And that's just, we wouldn't want to do that. So what we would do, and again, I don't know how much demand will come from this call or future folks that listen to it, but if we got to where we just flat out could not say the 50-50 mix was achievable, then we actually do have the ability to invest with Dial directly without the co-invest, and we could create some capacity that way. But obviously that people would not benefit from the improved economics. So that's why, there's probably about $20-25 million of capacity that we know we can release and facilitate, which we would encourage people to participate in.
But there is a possibility, and it would work out this way, if for whatever reason you do not have more sidecars, you just wouldn't call that last 10 or 15 or 20% or whatever the number works out to be.
That's exactly right. That's exactly right.
All right. Given Fund 2 has more credit-focused PE companies than Fund 1 did, does that change the 50-50 mix between capital gains and ordinary?
No, and I will tell you, we obviously don't know the last 5 firms exactly that will be in the fund, 4 to 6. But what I can tell you is that we don't expect a lot more credit. But even still, the vast majority of those managers, even in the credit space, they do a really good job with tax efficiency. So when you blend it all together with what we consider to be more capital gains focused vehicles on the other side, and also some of the ones that they're talking to right now, we would expect it to still be about a 50-50 mix. What has happened in PEO1 has been actually vastly superior to that. And the reason gets into some serious deep accounting is in the early years of the investment, there's a lot of amortization and depreciation that can be utilized to actually offset a lot of the ordinary income. So last year, as an example, I think we distributed 14% cash on cash. And of that, about 4 of it, actually, if I remember correctly, from my own personal K1, about 4 of it was actually taxable, and that was long-term capital gains. The rest of it was deferred, and we ended up with very little, almost no ordinary income. Again, that might be a little bit different with Fund 2, but we would still manage expectations to that 50-50 mix over the life of the investment.
And there's a question about the risk or the results if a partner liquidates it to other partners prior to the fund ending. Do you understand exactly what that question is?
Let's see. So talking about if somebody was just a limited partner in the fund just wanted to come out, is that what you're meaning?
I would assume partners, the firm partners, if they liquidate to other partners, we can skip that one. I'm not 100% sure.
So it does. I think I know what the question is asking. So no, there's no way that someone could come out and just leave and leave everybody else hanging. There's lots of protections in place to protect all of the partners in the event that somebody were to default on their capital commitments or something of that nature. Very, very significant protections there. So not concerned about that at all.
All right, and then there's a question about the catch-up. It is only on initial called capital, not the commitment. That's correct, is it not?
No. So the 8% catch-up, the 8% pref, I think, is what they're referring to. The pref is on all called capital from the time that it is called. So that starts the clock. So Dial has to earn give us all of our money back, plus an 8% preferred return from every single moment that they call that capital and accrued on an annual basis, compounded on an annual basis before they get to share in any carried interest whatsoever. And that's on the full amount. So that preferred, we benefit from that on the entire amount of someone's commitment and however much is called. But it is actually on called capital.
I think the question is about investors who come in now versus day one investors. I think there's some kind of catch-up penalty.
Got it. So the cost of money. I misunderstood the question. So yes, the 8% is only on the initial call. So those investors that came in July, they obviously made their initial 15% capital call. Anybody who comes in today, it is literally 8% annualized for that, whatever it is, 3.5 months that money has been out there, and only on the 15% initial call, not on the rest of it.
But we get the distribution on that on that called capital from day one. So we'll pay the quote-unquote penalty, but then get a distribution that probably will be greater than that. Well, it will be greater than that.
That is correct. That is correct.
All right. And we've covered that. Sorry.
The one that's not on here that we haven't talked about that I think we have to talk about is the exit. How do you get out of this thing? Is one that usually is a common question. And this one is different because it's not like a typical fund where it's a 10-year life with 2 1-year options. The private equity firms we're buying into, they're not going to want to sell a stake to someone who then has to turn around and flip it 3 to 5, 6 years later. So they're looking for people that are, for partners that are going to be there for as long as they need them to be. So this is a vehicle that does not have a definitive end date. However, everyone's going to have a way to exit. And there's three ways that somebody can exit this investment. And we'll start, as always, with the worst case scenario. The worst case scenario for somebody is that they just sell it in the secondary market. We will facilitate a secondary market after the investment period is over. Everybody will be asked in September if they want to put their name in the hat as a buyer or as a seller. And we'll introduce the buyers and the sellers, and they can negotiate with themselves and decide what they want to do, and we'll pay for that transaction. Anytime somebody's a seller in the secondary market, they may like the price they get, they may hate the price that they get. But that's a worst case scenario that they could get out in that way. We have not ever had, I can say this now, we'll be able to say this potentially forever, but we have never had someone sell for less than net asset value to one of our other partners. Any of our partners selling to another partner, they've always gotten net asset value. Now, the good thing about this particular vehicle, because it's a yield-oriented investment, it's a little easier to value. It's not like a venture capital where you don't know what it's generating. If something's generated 12% a year for the last 3 years, got a pretty good idea of where it's going to trade, and it may even trade at a premium to net asset value, but it could trade at a discount. But that's the worst case for somebody. The second possibility is just like every other private equity fund where the pieces liquidate, where let's just pretend that Golub goes public and Bridgepoint, sells to Blackstone or somebody else. In that event, we obviously get our stock or cash, whatever it is that's the currency that's been used, and that'll just liquidate and gradually be distributed. The optimal scenario, which is if Dial was on the phone with us right now, they would say is they plan to take this entire package public. Fund 3 and Fund 4, put it all together. It's literally the largest private equity manager as a collective group in the world by a factor of multiple 4, 5, 6 times. And you take that public, it's a yield-oriented vehicle, feel like it will trade very well. That's why it's realistic where you pay 6 times ENI and then, potentially see it trading at 9 times ENI. The reason that's also optimal for us is that it gives us stock, which we can then either sell or we can hold. We can take part off, we can keep it all, whatever we want to do, but we're not forced. Because one of the biggest problems for me and my family is, we have this great investment that's doing wonderfully for us, and then they decide to sell it, and then we have not only tax consequences, but then we got to figure out what we're going to do with it next, reinvest it. So the advantage of this, if they take it public as planned in 3 to 6 years, then we would end up with stock. We could hold it. We get our cash flow still. We'd have the increase in value that comes from that hopefully private to public markup. And ultimately, we can choose what's best for our family as far as liquidating.
And there's a question about your family and your firm's investment in this fund. You're at the same terms as we are, but obviously you don't have to pay your carry to yourself. Is that?
That is correct.
Yep. And then given some foreign companies own some of the PE holdings, is there any issue with PFIC?
Very good question. So there is none. All of that is sheltered through various structures to make sure that it does not pass through. If you have a particular, if you're investing through a foreign entity, we need to have a conversation. If you're investing through your IRA, no problem. There's no UBTI. We have an offshore block. We have a non-taxable vehicle and a taxable vehicle. So we block the UBTI and any PFIC problems that could come through as a result of that. So if you have a very unique investment vehicle that you want to invest through, we can walk through that and get the lawyer involved and Weaver involved who does taxes if we need to.
All right, and then the next question, there's a lot of articles about the amount of dry powder within the PE firms. Do we have any idea how much cash is on the balance sheets of all these underlying firms that we own?
So there is a lot of dry powder. It's really not so much cash sitting on a balance sheet. It's commitment dollars that have not been deployed. So as an example, I'll just use a sample. If you have a firm that has $1 billion fund and they've committed 4% to that fund, and that fund right now has not spent any of the $1 billion, well, that cash is not really sitting there on the balance sheet necessarily. It could be. But that's $40 million of future commitments to the fund. That's dry powder. That money literally may be on the balance sheet today. It also may be sitting in somebody's pocket waiting to be called. And that is usually more the way it's done, is it's distributed and then it's recalled at the time that it is needed. So they would it goes in and it goes out. If it is straight, left on the balance sheet, it's because they usually have visibility as to when it's going to be called. I will tell you that very little of the firms that we own stakes in have, significant cash balances on their balance sheet other than just for working purposes or for visible investments they know that they're going to be making very soon.
Right. And if Dial does a fund 5, do you expect that you would do another feeder fund or similar?
We'll look at it at the time. They have said publicly, and there was a misinformed Wall Street Journal article, I believe it was this summer, saying that they're in the plans for Fund 5. That's absolute baloney. They're not in the plans for Fund 5, and trust me, if we would know, and I asked them directly if they were doing that, and they laughed. So we don't know where they came up with that. They are doing something on the credit strategy side, which is kind of interesting, but they have no plans for Fund 5 at this point. I think it would take at least a year, if not 2, before they would even consider it, and certainly not until they finish investing Fund 4. I will tell you, as being on the limited partner advisory committee for both Fund 3 and Fund 4 is, there's no plans for it at this point. I would be surprised actually if they announced anything anytime soon. And from our standpoint, everything is a new underwritten situation. If they're doing it for the right reasons at the right time with the right opportunity set, we certainly will consider it because we think so highly of the team and the strategy. But ultimately, we look at every co-invest, we underwrite everything, and then we obviously would look at any new fund and underwrite it the same way and make sure it's going to meet our risk and return profile that we need.
And then in some of your materials, you indicate that you have run additional downside scenario stress tests that have more downside than Dial's hypothetical downside scenario. Are you willing to share these calculations and what those scenarios actually turn out to be?
We don't typically share what those internal ones are, just stressing the stress of the stress test. But what we show in this presentation is basically the same as what that is. We just haircut the balance sheet, and then we haircut the existing carried interest to nothing. And so what that ends up with is, instead of getting back that extra 2.1, that 1.21 turns into about a 0.8. And if you take away basically the balance sheet profit, and haircut it, instead of getting it back at cost, you assume a 30% loss on that. That takes out about 15. And then if you take out the carried interest of basically 0.2, that puts you down to, call it a 0.65 to a 0.75. And 0.8 is really where realistically it works out to be. So could I build you a mathematical equation to get to that? Of course I could. Do I think across a 10 to 12 different position portfolio, it's even realistic to think like that? No. If that's the case, candidly, we're all farming our own food and Armageddon has begun. It's really hard to imagine how all of those firms would never raise any more money, would never make another dollar, and would actually lose money on the balance sheet compared to what they've done for the last 20 or 30 years. It's theoretically possible, but it's really hard to even say that with a straight face.
All right, and then the last one here is, can you give some color on the assumptions used in like assets under management growth, how much funds they will raise, et cetera?
So it's different for every single investment itself. Now, in the scenario we showed here, what it is basically a modest growth from their previous fund size. So if they were a $3 billion growing to a $5 billion fund size, to a $7 billion fund size, and we've done all kinds of different extrapolations. But in this particular scenario, we show for kind of a base case, it is in essence the same pace that they have shown for the last decade, and extrapolate that with a little bit of a discount just for the law of large numbers. Obviously, you're not going to assume somebody goes from 1 billion to 2 billion to 4 billion to 8 billion. That's not a realistic scenario, even though it is happening. So we've gone with a very modest, growth rate of typically 20% type growth in assets under management from fund to fund, which obviously works out to be, depending on the spacing between the funds, 3-year spacing or 5-year spacing of when they come back to market. Then you end up with that kind of 6 to 10% type growth rate in assets under management, which is pretty consistent with what the industry is showing.
Very good. Well, that's the last of our questions, and David had sent us a document about how to invest, and I'll post that. But is there anything you'd like to add in closing?
No, I would just say in closing, first, thank you very much for setting this up, and really hope to get as many involved as would like to be involved. I would stress, make sure you allocate the right amount to this investment. Always be prepared to write a check for your full commitment, obviously. It's just good business. But don't undercommit, because that's what happened to so many of our PEO1 investors. They really wanted to invest $1 million, and now all of a sudden they're going to write a check for $500. And so, yes, they're going to do really well on the investment, but they really aren't getting as much exposure as they wanted. So I would encourage you to think about that 60 to 70 cent number as a realistic number for your commitment. The other thing is, if you can come in by the end of November, by the end of October, I'd strongly recommend that you do that, because of the fact that we feel very comfortable with what we see, that people that come in November 1st will get whatever they asked for. And people that come in, December 1st, they may get cut back very significantly. So if you can get comfortable and do your due diligence by then and finish, we would strongly recommend that you do that. And obviously let us know what questions you have. We're happy to have calls with anybody individually.
So the documents are due by October 31st, and when is the actual initial capital call? Same day?
The initial capital call is due 5 business days. And technically, just to give everybody a little bit of cushion, we have a standard policy on all of our funds. As long as it comes in by the 5th business day, it comes in as of the 1st. So documents and initial call would be due, I think that's November 7th in this particular situation. But the 5th business day of November, we need to have documents and the initial 15% call.
So documents are actually not due till the 5th. Is that what you just said?
That's 5th business day, yeah.
5th business day, okay. All right, well, thank you very much, and I'm sure you'll be hearing from us more in the future.
That's great. Thank you, sir. We'll talk soon.
Thank you. I think everyone's gone. Anybody have any comments, questions? I had no surprises. It's pretty much what I had seen in other webinars and read. Looks like a pretty darn good investment to me.
His presentation shows 500K minimum, but the deal summary page shows 250.
It's 250.
Great, thank you.
And there's a chance, if he ask, there's an outside chance they would accept 100, but that's not official.
And hey, Mark.
Yes.
Yeah, it's Kirby. He wrote me an email while the webinar was going on and said exactly the same thing. He had taken on a case-by-case basis, especially if somebody had an extenuating circumstance.
Yep.
Should we reach out to him directly, or is there just, you said there was a document to do the investment? Or?
Yeah, we'll post it. He sent one to Kirby and I just a little bit ago. Kirby's actually going to be the liaison for like this number 4th sponsor as a liaison, so thank you, Kirby. But we'll have a separate page up on 506, and then we'll post that document. But essentially, you'll send him an email with the amount, and then there's another link that you have to fill out identifying the entity that's investing. And then the team's going to send you a DocuSign document. So it can be done online, and looks like it's going to be a pretty easy situation.
And Mark, I posted that while the webinar was going on, so it's posted.
All right, there you go.
And I also went through the paperwork and filled it out myself this morning. And I haven't got the DocuSign back yet. I expect I'll have it tomorrow or so, but it was very simple. You just upload your I had 2 different entities I was investing with, but just upload your entity documents. They quickly got back to me and asked for another document. And so right now I'm just waiting on a DocuSign to come. So
you feel comfortable that a solo 401k can invest in that blocker fund and not have any issues?
Absolutely. And for those that are still on the phone, and hopefully not everybody's like me, but you could be. That was a lot of my conversation yesterday. Not only can a solo 401k or a Roth or an HSA invest in that block and that offshore, I had a real concern over cash flow for capital calls because I'm not earning any earned income, so I can't generate new solo money at the drop of a hat. And they will float you at an 8% loan rate with no, I mean, they're not like mad about it. They're not upset. They don't have any issue, because I actually had a problem because I get a lot more money come January if they made another capital call in December. And he goes, don't worry about it. We will float. We will float it out of our liquid fund for an 8% rate for 30 days, 60 days, 90 days. He said, we've got some really rich guys that will float for 6 months because they just are playing with their money.
Yeah, it sounds like that fund is pretty large. And
he said yesterday it was 150 million in the liquid fund.
And did you get a sense of what they actually invest in?
No, I did not. The guy that does the investing was out of the office. He took me there and pointed his office and said he's one busy person. But I'm sorry, I did not. Other than they're investing in people like you and I, because that's part of what they use that liquid fund for. And if you go back to your leverage question, that's really how he answered it. He answered it just the way I was told. They use their liquid fund to help bridge if some of their investors need it.
Interesting.
I was kind of shocked at, frankly. I really thought I wasn't going to be able to do it with a solo because I was too worried about a capital call that I couldn't make.
Yep. I mean, I still have about half my solo in stocks and stuff, so I always figured if I had to, I could sell something. But
yeah, you were smarter than me. I didn't do that.
Well, we'll see what happens the next year. It might be stupid. What stock market does, but it's worked out the last few years. All right, anybody else have any questions, comments?
Hey, Mark. Yeah, Mark, this is Paul. Oh, sorry, just real quick. The preferential terms, the lower 10% promote, basically regardless of who comes in at what level, even though we're not doing an SPV, everyone is eligible for that?
Yeah, I mean, the only caveat is I think Sadie invested in July, so they're researching if they can let her have the special terms. But based on the volume of calls, they're not actually tracking some certain number. So we're just at 10%, for everybody now. So we don't have to worry about hitting numbers. They've been kind enough just to assume we're going to invest a lot and not worry about exact thresholds.
Mark, this is Bo.
Cool,
there's not a second break like if we get to 15 million or 20 million.
No, it's down to 10 is as low as they go.
So Mark, if you look at all the material that give us the gross returns, so to come to net, should we just take off 10% of that or maybe 11% of that and to come out with the net numbers?
I guess which document are you looking at? I mean, some are already net, but I mean the dial numbers, which is what a lot of their graphs are very, if not the same, they come straight from dial. So if it is indeed that, it's probably the same because we're getting free on no fees on half. So our true net expense or net promote is 1 in 19, and if you invest directly with dial, it's 2 in 20. So assuming that the sidecar investments return the same as the broad portfolio, I mean the only risk here is the sidecar investments we're going to be more concentrated in certain PE funds than the dial fund itself, because it's pretty consistent against 10 or 12 underlying funds. So you assume 10% in each one. If you went through the example on HIG or whatever the one was, we're going to be almost 20% into that PE fund because the sidecar deal we put 30 million into out of the 350. So the one actual risk that we do have instead of going direct is concentration risk.
Right, because the two funds right now are about 36% of the PEO2 fund.
Yep.
HIG, yeah. Mm-hmm.
So that is the to get this 1 in 19 instead of 2 in 20. I mean, if we want an SPV, it would be 2 in 25. So it's 1 in 19 versus 225. And so that 6% savings, the only risk that I can see is the concentration risk on whatever the sidecar deals are. They anticipate 5 or so. So those 5 firms are going to be, double the percentage as the other firms in the fund, if not more.
Hey, Mark.
Yep.
One thing just to make sure everybody understands is going back to your question about solo money, if you made a $250,000 investment, you can split that, and you don't have to split it evenly. You can split that between offshore and onshore. So, I'm going to split mine evenly, but just because I am, but you can put in, any varying amounts in each one. So I don't think that was crystal clear. I know I talked to Bo yesterday about it after I got clarification on that, I believe, but I just want to make sure everybody knows you can take 250 and split it. You don't have to put 250 in each either.
Yep. And if you put 250, most you'll put in is 50 this year and probably 50 next year. And then it's actually going to be less than that because of all the cash flow. So
yeah, I mean,
250 sounds like a big investment, which is, larger than I would ever have done. But in this scenario, even at $500,000, I'm assuming I'm going to put in less than $100,000 a year. Potentially $50,000, $60,000, which makes
much more. That's exactly my thinking too. Otherwise, I wouldn't be at the number I'm at.
Yeah, I'm doing a number that I would not do on any other fund, but with the downside protection, to me, this is one of the best investments at this stage in the cycle I could have imagined. So I'm excited about it.
Yeah.
All right. Anything else? I will convert this and upload it, and it should be up there in about an hour or so. And thank you very much. And I guess I'll see a lot of you guys in about 3 weeks. We're getting close to finalizing all the plans, so we'll see some of you guys in person.
Yep.
Thank you, Mark.
Forward to it.
All right. See you guys.
Thanks, Mark.